Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Bob Michael, Head of Global Fixed Income for JP Morgan. Hi Bob.
Hello Emma.
So we're here today to talk about fixed income, and the thing hanging over the entire market is the Fed. So when do you at JP Morgan expect Feds to raise rates?
Well, there's no doubt the Fed does want to what they call normalize interest rates, which is code for raising the Fed funds rate. They're trying to do it as passively as they can so they don't disrupt the markets, they don't tighten financial conditions accidentally, and more so that the rest of the world has a chance to heal and recover. So I do expect them to try and get one more rate increase before the end of the year. That would move the Fed funds band up to 0.5–0.75%. If the global economy and the US economy look a bit firmer than they do today, I think they could do two before year end. I think that puts the Fed funds target rate neatly at that 0.75% to 1% band. And I think it achieves what they really want to achieve, which is to put some air into the front end of the yield market and stop penalizing savers.
And at the beginning of the year, we'd have said that UK was in the same basket as the US, looking to raise rates this year. But of course, we've had the Brexit vote, which means the US seems to be on its own with its policy it's taking, raising rates, and the rest of the world is lowering them. How does that affect fixed income investors?
Well, that's very true. That Brexit, I think, has been a real game changer. And if you go back to the start of the year, the Fed's playbook would have been to raise rates at least 4 times this year. And I think to do 1, maybe 2, is much, much less than they would have anticipated. So they are trying to build in the uncertainty of what Brexit will bring. And the fact that Article 50 hasn't been triggered yet and likely won't be triggered until January just lengthens that degree of uncertainty. I think what it means for the bond markets is that people can expect yields to stay lower for longer. So that's not going away. I think the US bond market will play the game of guesstimating where the terminal Fed funds rate will be. Will they get to 1%? Will they get to those mythical dots at 3.25%? And what typically happens when the Fed raises rates is the yield curve tends to flatten out around the terminal rate. So if they get to 1%, I think you could expect yields in the 2-year all the way out to the 30-year to be within touching distance of 1%, and that's our expectation.
Of course, that means that it is difficult for you to find value within the bond market. But where are you seeing those greatest opportunities?
Well, I always like to think that in a market where central banks are printing money, you have the Bank of Japan, you have the European Central Bank, together they're printing close to $500 billion every 3 months. That's a lot of money, and people forget it just doesn't sit on balance sheets. It actually goes right into the bond market, so it backstops a lot of things that they're buying. So I like to think in this market we should look for yield, because so much of the world's bond market has negative yields. If I look at the 10-year Treasury, which today is about 1.6%, over 85% of the world's government bond markets yield less than 10-year Treasury. So that's already a lot of yield. And I think you want to buy the kinds of things that the central banks are buying in 1 degree of separation. So if the European Central Bank is buying European governments and European corporate bonds, a lot of the holders of those securities will sell them to the ECB and they'll export that money to the US. And they'll buy US investment grade corporates, they'll buy US agency mortgages, they'll buy European high yield. You're seeing the same dynamic in Japan, where the holders of JGBs are selling them to the Bank of Japan, they're buying US securities, they're buying Australian government bonds. So I think a blend of government bonds and credit, if you have reasonable return expectations, are a pretty good place to be for the foreseeable future.
Bob, thank you very much.
Thank you for inviting me.
This is Emma Wall for Morningstar. Thank you for watching.